Tonight we begin with a truly staggering figure, $1 trillion. That's the size of China's trade surplus, a record-shattering number that's sending shockwaves through the global economy and capturing the attention of leaders and analysts everywhere. This isn't just another financial statistic to file away, it's a powerful signal that the world's economic order is being fundamentally rewritten before our eyes, with consequences that will ripple for years to come. For every ship leaving Shanghai brimming with goods, far fewer return carrying foreign products. The scale of this imbalance is not just significant, it's historic, and it's growing. No nation in modern history has ever amassed such a vast gap between what it sells to the world and what it buys back. To put it in perspective, $1 trillion is more than the entire annual economic output of many developed countries, an amount that would rank among the world's top economies. But this story isn't just about China's unmatched export power, it's also about its surprisingly weak appetite for imports, which is sending a tidal wave of cash into China and giving Beijing unprecedented leverage on the world stage. The result? Global markets are now flooded with Chinese goods at prices few competitors can match, creating both enormous opportunities for consumers and deep anxieties for industries and workers worldwide. Years of targeted industrial policy, relentless state investment, and a focus on manufacturing excellence built this foundation. But recent global disruptions, like the pandemic and supply chain crises, have supercharged China's dominance. While other nations struggled with inflation, labor shortages, and supply chain chaos, China's factories kept humming, churning out everything from electric vehicles to smartphones, solar panels, and more. This unprecedented surplus raises urgent questions. Can the world truly sustain such heavy reliance on a single nation's output? What risks does this concentration pose to global stability? In this series, we'll break down how China reached this milestone, why its own people aren't spending as much as expected, and what all of this means for the future of the global order. The old rules of trade are being rewritten in real time, and every country, every company, and every worker now faces the consequences of this new reality. The world is watching closely, and the stakes, both economic and political, have never been higher. For decades, the phrase "made in China, sold in America" defined the very essence of global trade. It was a symbol of how interconnected the world had become, with American store shelves filled with Chinese goods. But today, that story is rapidly changing. Trade wars and rising tariffs have forced China to rethink its export strategy. Instead of relying heavily on the US market, China has pivoted, redirecting a significant portion of its exports toward Europe and the fast-growing economies of Southeast Asia. Now, European consumers and ASEAN nations are emerging as the new engines of China's export boom, driving demand for everything from electronics to clothing and machinery. Many goods are now shipped to countries like Vietnam or Malaysia for final assembly, a clever move that sometimes helps sidestep tariffs and trade barriers before products reach their final destinations. This shift has transformed Southeast Asia into a vital hub for China's export strategy, deepening economic ties and fostering new regional partnerships that benefit both sides. Australia's trade relationship with China has also evolved. Raw materials like iron ore and coal flow to China, fueling its factories, while finished goods make their way back to Australia and beyond. Even as political tensions simmer and diplomatic challenges arise, the reality is that economic interdependence continues to drive trade forward. Chinese exporters have become experts at navigating these geopolitical obstacles, diversifying their markets, and reducing reliance on any single trading partner to ensure stability and growth. The result is a more complex, multipolar world of trade, with new routes, new winners, and a constantly evolving network of global commerce. The old east-to-west pipeline is being redrawn for a new era, as China's exports find new homes across the globe. While China's factories are booming, its own consumers are holding back. The trillion-dollar surplus is as much about weak imports as strong exports. Chinese households are saving, not spending, wary of a shaky property market and uncertain jobs. The real estate crisis has eroded the middle class's sense of security, making big purchases rare. This negative wealth effect ripples through the economy, cutting demand for everything, including imports. Private companies are also cautious, holding off on investment amid regulatory crackdowns and slow growth. Instead of buying foreign machinery or technology, they're preserving cash. Beijing's efforts to boost consumer spending have struggled, with stimulus often focused on production, not people. The result? An economy that's a global export powerhouse, but weak at home. This internal fragility is the other side of China's trade surplus. It's a challenge Beijing has yet to solve. Why are Chinese goods so cheap and competitive, even with tariffs? It's a question that puzzles many shoppers and business owners around the world. The answer comes down to two main factors: a weaker yuan and falling factory prices, both of which work together to give China a powerful edge in global trade. The yuan's gradual decline against the dollar and euro means foreign buyers get more for their money, making Chinese products even more attractive on the international market. This isn't accidental. A softer currency gives Chinese exports a built-in discount, making them cheaper without any change in quality or production. For Chinese factories, every foreign sale converts to more yuan, boosting profits and encouraging even greater production and investment in manufacturing. Meanwhile, intense competition among manufacturers and weak domestic demand have forced factories to cut prices just to stay afloat. These savings are passed on to global buyers, widening the price gap with foreign competitors and making Chinese goods the go-to choice for cost-conscious importers. While US and European factories face rising costs, stricter regulations and sometimes even closures, China's exporters enjoy both currency and price advantages that keep them ahead. The result? International buyers flock to Chinese suppliers, reinforcing China's dominance in global trade and making it the world's manufacturing powerhouse. This pricing power is a key driver of the trillion-dollar trade surplus that China enjoys year after year. It's a potent mix of financial strategy, relentless cost-cutting, and a willingness to adapt quickly to changing market conditions. The world's factory is running at full tilt, and with these advantages, few can keep up with China's pace in the global marketplace. China's trillion-dollar surplus is more than an economic headline, it's a political shockwave. In Washington and Brussels, alarm is growing over what's seen as an unlevel playing field. The response: new tariffs, anti-subsidy probes, and a shift from open engagement to confrontation. For workers outside China, the impact is real: factory closures, job losses, and shrinking industries. The global trading system is fracturing, with the WTO sidelined and economic blocs forming. China's surplus is accelerating this fragmentation, pushing the world into a new era of rivalry. The global order is being tested, and the outcome is uncertain. For Chinese exporters, these are boom times. Factories are busy, profits are up, and China's export engine is humming. But this success brings risk. Over-reliance on foreign markets leaves China exposed to global downturns and political backlash. If major economies impose more tariffs or hit recession, China's export boom could stall overnight. The very dominance that fuels China's growth is provoking a global pushback. Trade barriers, investigations, and coordinated resistance. Beijing faces a dilemma: keep pushing exports and risk isolation, or rebalance the economy and face painful adjustments. The export model is a double-edged sword, vital for growth but increasingly vulnerable. China's trillion-dollar surplus is both a symbol of strength and a warning sign. The world's response could reshape the future of global trade. China must adapt, or risk becoming a victim of its own success. The stakes have never been higher. With the world watching, Beijing faces tough choices. Policymakers know over-reliance on exports is risky, but shifting to domestic demand is challenging. Stimulating consumption, through tax cuts, vouchers, or a stronger safety net, is on the table, but old habits die hard. The government prefers building factories over handing out cash, and debates rage over the best path forward. Letting the yuan strengthen could help balance trade, but risks hurting exporters and jobs. Meanwhile, the US and Europe are demanding action: open markets, fairer rules, and a more market-driven currency. The threat of more tariffs looms if China doesn't act. Beijing must balance supporting exports with nurturing domestic demand, all while managing global pressure. The decisions made now will shape China's and the world's economic future. The next move is critical. China's export dominance is forcing global companies to rethink their supply chains. The new mantra, China Plus One, keep some operations in China but diversify to places like Vietnam, India, or Mexico. This isn't a mass exodus. China's infrastructure and scale are hard to match. But it's a strategic shift. Companies are hedging against disruption, building resilience, and localizing operations to serve key markets. The result, a more fragmented, regionalized supply chain. with products assembled across multiple countries. Developing nations gain new opportunities, but complexity and costs rise. The simple, efficient supply chains of the past are gone. Now, resilience trumps efficiency, even if it means higher prices. The global production map is being redrawn. The world's factory is no longer alone. China's trillion-dollar surplus marks a turning point, the end of one era of globalization and the start of another. The old consensus, deeper integration benefits all, has shattered. Now, trade is about security, resilience, and strategic competition. Governments are intervening, friendshoring, and prioritizing national interests over pure efficiency. The world is less integrated, more divided, and facing tough questions. Will prices rise? Can global challenges be solved without cooperation? What role will China play? The answers aren't clear, but the choices made now will define the global economy for decades. History isn't over. The story of trade is being rewritten. The old map is gone. The new one is still being drawn. A new, uncertain chapter has just begun.